Good morning, everyone. Welcome to the On Time, On Target Morning Brief, where we invest in fighter pilot precision on a daily basis. Today, we're going to talk about the same theme that is going to dominate CNBC from now until about 2 p.m. Eastern tomorrow, and that is inflation. Specifically this morning, the market, which is up across the board, a little bit surprisingly, because we got a producer price index number that is the largest 12-month number we've ever had, so up 6%. So if you remember consumer price, we've had CPI numbers, which is a little bit different. That's what we're spending. Producer price is what they're paying to create products. So but the last 2 months, we've had 5+% in the CPI. We just got a 6.6, I believe, is the number from this morning. We'll catch it in the headlines, but kind of a eye-opening sort of number, almost breathtaking, if you will. And the market's laughing it off. So we're going to talk about that as far as, the Federal Reserve and Chairman Powell, and they start their meeting today, and their announcement's going to be at 2 p.m. Eastern tomorrow. And what are they going to say about this inflation thing? Largely, if you were listening in earlier, Kramer's going to say that Jay Powell says, "I told you so," right? And I think that's largely the case. I don't think they're going to even talk really about anything other than, yes, we've been saying this will happen and it's going to happen. One thing I heard this morning I hadn't really thought about is it could be a little bit artificial because people are spending a lot of money right now. So I kind of reflect personally when I hear that, and it's just like, well, yeah, personally, I am spending a little more money this summer than I would normally because we didn't spend money basically last summer, or as much anyway. So your normal spending patterns are a little bit off, and I think people are willing to pay up for things this year, which is going to cause inflation this year, but that doesn't mean I'm going to pay up next year. NFL tickets are going an all-time, ridiculous amount for the upcoming season, but that doesn't mean that's going to relate to the 2022 season, right? It's just everybody wants to get out and go and do things right now. So I think that's also helping for the, when you're talking about inflation, is it permanent or is it transitory? That would lead to this being more towards a transitory theme this summer. And if you remember, we talked about this a few times already, but two things cause inflation: scarcity, right? Scarcity drives the price higher on the supply demand thing, and monopolies. And even though the government's always looking into our large companies as monopolies really means you, the consumer, are getting price gouged, right? So you could argue, sure, Netflix, Apple, Google, Amazon, they're all monopolies traditionally, right? Just due to sheer size, and they dominate the market share, but they're turning around and really taking it to us as the consumer, right? They're, Netflix isn't raising its price. So they raise it once a decade, not once a quarter, right? That would be price gouging. Amazon delivering stuff to my door for like next to nothing with their annual membership, which they haven't raised as far as I know in a while, or forever, I don't know. They're not really taking it to us. You could argue maybe Apple's charging too much for their phones, and probably agree to that a little bit, but yeah, it's not out of control by any means. So really, your traditional inflation drivers aren't there, but your transitory ones are, i.e., we're spending a crap ton right now, and there are some shortages out there. Chip makers are causing shortages in used cars, of all things. If you want to sell a car right now, now's the time to do so. Same thing with lumber prices and the suburbanization of people living in the city to go out to the suburbs is causing housing inflation, which is kind of eye-watering in a good way. If you own a house, if you're trying to buy a house, it's eye-watering in the other way. But it's, these things are kind of localized. They're kind of focused, and I do believe they're transitory. So I think that's why the market is literally yawning this off today and is actually up in the futures. Now, I do think some of this is going to come home to roost a little bit. I do think the inflation trades, is what we're going to talk about today, are a good idea for a portion of your portfolio. Not all in, like John Tudor Jones said yesterday. You don't put 80% of your portfolio into gold, that sort of thing. But it's certainly something to have in your portfolio and take a look at as far as a capital preservation strategy, if you will. Sacrifice some of the upside that you might miss out on for the hedges that are traditional inflation hedges. So that's what we're going to talk about today. We'll pull the charts on 5 different things: gold, silver, property, volatility, and tail. You haven't heard me talk about tail, which is a tail risk ETF out there, but it also performs well if the market would ever flip Do you think that a floor is set with higher prices since people are willing to pay for it? I agree, Berner. That's a great insight. I agree 100% in housing. I don't think we're going to, I don't think housing is necessarily a bubble in the means that it's going to pop and housing prices are going to go back down. I think we're here. I think you're right. This is the new floor in housing. As far as like NFL tickets, like I know you just you piggyback there. No, NFL tickets, concert tickets. I think all of that stuff's going to settle down once we kind of get out of the rats out of a cage mode of wanting to, get out this summer and do things, not only as adults, but as families. If you got little kids, they want to get out and do a whole bunch of stuff right now. And you're kind of paying any price to do so because largely you don't care. And, some people obviously are impacted, and I, feel for those folks that had a tough time financially coming out of COVID, but there's a lot of people that are sitting around where money just kind of, their normal spend rate wasn't there. So they have more money than they normally do, if you will. So anyhow, good insight there. Good question. And with that, if you're catching us on replay, make sure you click the subscribe notifications bell. If you want to catch us live, there's a chat window and a Q&A window right here in the room for $25. Come on in. With that, let's go ahead and get started. All right, welcome back, everyone. It is Tuesday. It is Tuesday, June 15th. All right, make sure you have your Q&A window and your chat window set up appropriately. Standard disclaimer applies. This is a financial education presentation. You have to do your own due diligence before acting upon anything you hear this morning. A full disclaimer information is available at ototnow.com. All right, mission objectives are standard: grow our money, protect our money, and live off our money. When you start talking about hedges, it's in the inflation trades, it's I'm not trying to make money on these trades. I'm not going to buy gold to, make 20, 30% a year, or silver, or buy real estate. Honestly, you're not looking, localized, sure. And, I was talking with somebody yesterday, great conversation about real estate. And they've had several properties, and I've had 5. I wouldn't call that necessarily a lot, but enough to have seen have some scar tissue as well as some amazing gains, both sides of the spectrum. But the real estate like flatlines for like 10 years, and then you get these bump ups, right? So it kind of depends on when you own it. And the question now is, should you sell your real estate? And it's like, yeah, if you're sitting on a rental, boy, is it time to unload that thing. You've made your rental income, or covered your mortgage, or whatever your goals have been. But if you're at a breaking point with your leasees, yeah, now's the time to let it go. Take the gains, move on, right? If a property is appreciated 30% in the past 6 months or a year, it's not going to sit there and continue to do that year over year, right? So take the gain, move on. Slap a high five with yourself for the your savvy investing, much like you do when a stock blows up through the roof, right? You're just not going to get that year over year. So when you think of gold, silver, or real estate, you're thinking really long-term wealth protection versus the get rich, right? So it's the stay rich, not get rich. So that's what we're going to be talking about today. The inflation trades, you got 5 of them down there. The only one that I really don't think I've talked about is tail. I met with a Cambria guy last week, Clay, shout out, who explained this to me for over an hour of exactly what this does for you. And I like it a little better. A couple of the folks in the room like VXX. I've been in and out of VXX. I still have some pain train, but I think tail's a little better hedge there than VXX. So next time I go to hedge significantly in my portfolio, I'm going to go with tail instead of VXX. But we'll take a look at this. All right, our flow: long, short, open, short, long. We'll do market review, headline review. We'll look at these 5 names. We get in our short-term execution. For the day trading stuff, I don't really care for anything I see except for one that makes me cry a little bit, and that is DraftKings. DraftKings came out with a heinous headline this morning. Stock is dropping like a rocket. Was at 51 an hour ago. It's at 45, and there's just no floor below it. So unfortunately, that's the day trade of the day, even though I have a significant size of it myself for long-term investing, which I'm not selling, diamond hands, check me out. But for a short-term trade, that one fits the bill better than anything else I've got for you. The two longs are meh at best, and the other short QD is pretty good, but DraftKings is better. Anyhow, we'll take a look at that here in a second. Let's take a look over to ThinkPipes, and we'll check out. There's your four screens with the one long and then the two shorts set up over here. Here's your DraftKings, just making me bleed out of all of the orifices available. Painful. All right, here is the 9-month look at the SPY. So again, keeping the big picture in mind. Markets making new highs and powering higher. I think yesterday was the 28th new high of 2021. Doesn't seem like it, but it is. And again, largely there was a rotation in tech there. But for those of you that own Apple, chuckle, everybody, right? You saw a 2% move up in Apple yesterday. So Apple above 130, finally getting some love, which is kind of nice because it's been left for dead a little bit. But we are starting to close in on the anticipation of the release of their whole new suite of products, which is going to be the, iPhones and such in September, October timeframe. It's close. Think, school's going to start back up in a couple months. Football season's going to start, and new eye stuff for you to buy. We focus in on the 5-day of the SPY. You can see there it's just powering higher. So a lot of momentum going into the close yesterday, and that's carried over into today. All right, let's go ahead and take a look at the headlines right now for refresh the futures for you. That's what we've got. So NASDAQ did flip red. Everything else is just barely in the green. Europe green across the board. Asia mixed. Pretty big difference there, plus or minus 1% across the board there. The 10-year, again, the inflation measure, if you will, sitting at 1.5%. So 10-year, don't care. Oil above 70 really hasn't affected too many things. I mean, obviously gas prices, but they're not insane. They're just inflated. There's your gold and silver. Gold and silver, I'll show you the charts. They've actually sold off a little bit lately. And then Bitcoin bounce has been in effect. Everything else just kind of trickling along. All right. The calls of the day: Tesla got an upgrade. Apple got a downgrade. What? Don't you downgrade my Apple after a day like yesterday? But they did, because that's what they do. And I don't want to make fun of analysts on Wall Street, but then again, I would say these are not the highest paying jobs out there. So then again, are these the intellectual minds that you should follow? I don't know. You decide. All right. Amazon, yep, largest retailer, passing Walmart. That shouldn't surprise anybody out there. Here's your 6.6 number, producer prices. So again, thinking what it costs companies. Now, a lot of people don't care about the PPI because guess what they do? Yeah, they pass that on to you and me. Oh man. But so it's not as big a deal as the CPI of what we're all paying. So it might be a flow through. There's your DraftKings down 10% and falling. Kind of, Jack Ma getting some, a lot of people tie the Alibaba stock to Jack Ma, even though he's kind of long gone. Yeah, he's off doing painting and hobbies and things. So I don't know. You could separate that out. I think Baba is going to go significantly higher here soon. I just don't know when. All right, let's take a look at gold stock here, or excuse me, the gold ETF, which again holds gold, physically gold for you, so you don't have to. So it's come down, right? Here was the big inflation run up, and it's really actually come down, popped a little bit yesterday. So that's pretty decent. And then silver, we'll talk about for the market open here. Same sort of thing, but not as much. Again, I still think gold is better here than silver, even though despite the price points. But again, especially with the sell-off it's had in the past couple of weeks. So we'll come back to that after the open. All right, here's TD Ameritrade ThinkPipes. We are 30 seconds out from the open. Give me a second to get set up. Good morning, everyone. Welcome to the On Time on Target play of the day. We have 5 seconds to the market open here on Tuesday. A lot of positivity going into the open. There's Bell. All right, this is the 1-minute chart all the way on the left. This is the S&P 500. Again, it's pretty flat. We have MARA, which is Marathon Digital, added to the S&P, the Russell 2000 index. So that was gapping up, now selling off. We have QD, which has the negative earnings, which I just took off the screen for you. So let's take a look at that. So losing a $1.92 a share. So negative storyline there, and plenty of volume for you. And then really the story of the day is DraftKings. I don't know that it's kind of hurts my heart too much to call a trade here, but they really fit the bill. As far as our trading strategy, which doesn't mean I can call the trade. I don't think I can do it. I'm going to watch it here though. Look at the millions of shares. This is largely short covering. Maybe people are buying it here. I still think it's a great long-term theme, but in accordance with everything, we're going to call the high of the day and then call a short, and I don't like it, but we're going to call it. I would imagine DraftKings is probably either going to get on CNBC soon or defend itself at some point. But right now, 46 is the high of the day, which puts the entry point at 45.50 to the downside. So again, taking this short, I'll call the trade, take it at your own risk. So 45.50 short in DraftKings. I'm kind of hoping this just fails and powers up to about 47 or so, and then we can stop talking about it. All right, while we're waiting on that, not a lot of movement here in QD, so that's going to be tough to short. And then, of course, this marathon long just completely failed. Look at the market, gapping down. We're in the red now, not gapping down, but striping down here in the first 2 minutes. So we shall see. All right, your entry point on DraftKings short if you want it. Again, at your own risk. But it's setting up nicely. Again, 50-cent stop, 45.50 short, covering that high of the day of 46. All right, got to be patient for it. I'm going to switch out of marathon. Don't like that at all. Let's look at SIOX. Gene therapy trials. Again, this is a long in SIOX. All right. Things changed here in DraftKings. 46.20 is the new high of the day. So that would put 45.70 as your entry point. Again, would prefer this just to power higher, but 45.70 short is the entry that we're looking at. 3 minutes into the day. If this continues green for the first 5 minutes, I'm going to bail on it. But other than that, it's again, we're using that 50-cent stop. So there, it powered higher. So the math is changing. So we got to redo the math. 45.80 is now your entry point with a 46.30 stop. Making just a note for myself. So I'm going to look away and put something else in here. So SIOX, do you have an entry here? It's tough at that price point. All right, things changing again in DraftKings, 46.50. So 46 would be the entry point. 46 entry point short. Okay, there it hits 46. This is short. This is a high risk trade. I'm not doing it myself because I have too much DraftKings already. I'm going to short my own position. But 46.50 is your stop. It is a beautiful setup on the chart and a beautiful storyline of negativity, but we shall see. So 46, 45.50 will be the first R to the downside. Second R, 45 even. 44.50 right here on the chart would be your 3R point. So I've never really rooted against a trade, but this would be one I would want to fail. But the setup is basically perfect, especially with a red market. All right, SIOX just flipped and went higher here, so could have taken that troubling price point there down below $3. All right, and there was one more. CLF had an interesting story this morning. It didn't fit our mold, but it had a nice pop-up on they upgraded their financial guidance. So if you remember, when you have earnings, which they didn't have, but earnings, you have top line, bottom line, and then guidance. Well, in between earnings, you can actually update your guidance anytime you want, and they did, and the stock was up about 3% earlier. It's not really holding that, but again, CLF's not a bad and long-term investment anyway. All right, so here's our trade going up to 46.50. 5 minutes in of green. It looks like we're gonna get busted out of that trade. So just wait for it to hit. There you go, 46.50. So busted out of the trade, making some money back for me though for long term. Those of us for have it long term. But anyhow, so not nearly the negative story that it was out earlier. And nope, I don't see him on CNBC yet. But I'd imagine the CEO is probably getting showered up and ready right now to be on TV to defend himself. All right, let's go take a look at what's going on in the big picture out there. WNRS up 7%. That's kind of a high risk play, if you will. AMC, this is supposedly hashtag AMC day. I think, I'm not sure that Wall Street Bets and the Reddit community are allowed to declare like national holidays and stuff, but they probably don't think that they can't either. There's a lot of knots in there, but yeah, they probably think they can do that. So why not? So it's AMC day. So let's just look at AMC stock. Let's waste 30 seconds of our life on this, but down to 42, up at 60. Again, I have it in the book because you see it right here. So I've got somebody that's into this pretty heavy, to be honest. So, you know, good for them. I'm rooting for them as a client. Once they sell, though, I'll be rooting against it. Luckin Coffee up 4%, right? Get your Luckin Coffee before it gets cold. The 3.6 up to 930. I said I wanted it to hold 9 yesterday. It barely did. Or it went back down below 9 probably right after I talked about it, and then got back above. I think closed at 903. So anyhow, up nicely today to 935. That looks good. All right, some DraftKings options. So those are for covered positions. So again, that's a hedge for the DraftKings options. I see Apple options also in the red. That means Apple's selling off. I'm looking for it. It's up, not bad, 0.6%. Clickstream down 10%. TQLB, again, another high risk play. There's your DraftKings at 7%, but it was 11% earlier. So it's bouncing nicely, if you will. And nothing else particularly of note. All right, so let's switch out of this and go back over to finish talking about our inflation trades. So what are you going to see show up in your portfolio? You are going to see some gold, maybe some silver, but we talked about, so gold, I do like the entry point here. I'm on another screen just seeing if gold is up or down today. Flat, basically. So not a bad entry point here at 175 on the GLD. Silver, I'm not as attracted to right now just because of this chart. It's already kind of run up. So obviously, if you have a smaller portfolio, silver would make more sense due to the smaller price point. What has also run up for those of you that have significant portions of this, i.e. 6 figures or so, check out this run. So PPTY is US diversified real estate ETF. So literally you're owning land. So when folks are like, hey, I'm going to get a rental property, I'm like, okay, you know, that sounds fun. Have fun, you know, swapping out water heaters and all the other, you know, kicking out renters and all the other stuff that goes with owning, you know, rental properties. And I've done it. It's just, you know, it can be great. You don't know, right? It can be great. It can be miserable. But I will tell you that it's going to be more work than owning these 4 letters, PPTY, which is doing the same thing, where you can honestly forget that you even have this, right? It's so stress-free that you simply let somebody else worry about it and watch this chart go up, right? So you made a lot of money in capital appreciation, and it's kicking off 3.3%. I don't know. That's kind of like your traditional long-term real estate return. So consider just going into this thing and, you know, having less stress in your life instead of having a rental. So especially now the rentals are run up so much. So consider. All right, so that's PPTY. The other 2 I'll talk about is volatility, the VXX, which we haven't talked about in a while, because look at this chart. Painful. All right, this chart, remember it had the reverse split of all things. You know, it has basically gone from 120 down to 30. What's that? A 75% loss. Performance year over year, 80% down 80%. So if you're in the VXX, you're waiting for moments like this, which we had a year ago, which, you know, I think will happen again. And then you're looking to get back out of it. So I have a price point of around 40 here. So I'm just going to sit. I know volatility is going to pop at some point, but I may have to sit and bleed for a while with that position. for that to happen. A similar chart, which I like better, and which is what I'm going to use next time, is this tail. So tail stands for tail risk, and not to throw some statistics at you, but having had three up to and including three PhD level statistics classes, I will tell you that tail risk is a real thing. So it's off to the tail of the bell curve, if you will, out past that like 3 sigma sort of thing, if you want to nerd out for a little bit. But when you own a fund that's designed for tail risk, this exactly offsets. So this is the inverse of the market that's been going up and setting new highs. If the market sets new highs, tail is going to set new lows. So if you're sitting there, what do I do when the market's bouncing off of new highs? And I think there is inflation out there, and I think the taxes are going up. Is you invest in something like tail. So I'm not ready to pull a trigger, and buy a whole bunch of it, but I'm certainly going to start nibbling into tail as a hedge. And then, of course, if we start getting some crazy tax talk, like taking the estate tax down to $1 million from 11, or the top, tax rate personally being over like 50%, crazy tax talk is going to hit the market. That's when you'd want to pick up some tail as hedge, as tail ETF, as a hedge, and then basically looking to get back out of it once the market resumes its march higher. All right. That's it for the inflation hedges. As far as the taper tantrum, I was going to talk about this yesterday, but we got cut off. The taper tantrum is we talked yesterday about BlackRock and the Federal Reserve and buying bonds, right? All that quantitative easing is they're going to sit there and buy up bonds, which basically props up the bond market, which is the debt side of things, which in turn props up the equity market as well, right? Because you have money flowing into the market. At some point, though, that needs to stop, right? So that take away the punch bowl from the party sort of thing. And then the bond prices have to be sufficient on their own to hold there. And if they're not, that's when you see the bond market come in and the stock market gets drugged down with it. So if you will, all kinds of analogies. It's taking the punch bowl away. It's taking the crack away from the crackheads. It's taking the steroids away. It's basically we've been priming the pump for a long time to get through COVID, and now eventually that will have to unwind. Well, that's the taper tantrum, and the tantrum is in relation to the market selling off, which can be a good 10-20%. So we don't know when it's coming. It'll largely be Fed announcement induced, which again is tomorrow at 2 p.m. So all the investors kind of hold their breath every 6 weeks when the Fed has their meeting and then makes their announcement that they're not going to take away the punch bowl. So, all right, that's all I've got for you today. So see you guys back tomorrow morning. Bye.